What's up, traders? So today I'm going to show you the 3 data points that I look at before entering into any trade. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader, and I bring in multiple 6 figures a year trading options. And I use the stock market to not only pay for my lifestyle, but to also pay for the lifestyle of my wife and our 6 children. So for me, options trading kind of came as a necessity. I started trading during the pandemic, and at the time, I had 2 very successful restaurants open, and I also had a photography company. However, when the pandemic became bigger and bigger and they started having people stay at home, I essentially had to close down all 3 of the businesses, and that effectively took my income to nothing. So at the time, I had already been an investor, and I kept hearing a lot of things about options trading because it's of course something you can do at home and make money no matter what's going on in the outside world. So during that year, I really took the time to sit down and learn options trading. And since then, I've kind of developed my own strategy that has allowed me to bring in multiple 6 figures a year doing so. But that's enough about me. Let's get down to business. So I have multiple different option strategies that I use in order to generate the income that I do. But one of the strategies that I use a lot is the wheel strategy. Now, if you're not familiar with the strategy, that is when you sell a put initially in order to buy a stock at a cheaper price. If we're taking on the risk of the stock dropping, you get paid a premium up front. Now, oftentimes the stock typically doesn't drop below your strike price. However, if it does, you can then sell a covered call in order to get rid of the shares, and you also get paid a premium for doing that as well. So to sum it up, you sell a put in order to buy a stock, and then you sell a call in order to sell a stock. And for both of those steps, you get paid money each time. So when you're doing the wheel strategy, the first step is selling a put. So there are 3 data points that I look at prior to selling any put. And the first one is the delta. So right now I'm currently in the options chain for Nvidia. We can see the current stock price is $138. And now when I sell a put, I go typically around 45 days out. So I already select my expiration date, which is January 10th of 2025, which is currently 39 days out from today. Now, if we scroll down to the put side, we can see here that we have a column titled delta. Now, delta is simply the probability that the event occurs. So if the delta is showing a 0.10, it is saying that there is a 10% chance that the stock price drops to that strike price by the expiration date. So if we look here, right here, we have a delta of 0.12 for this $120 strike. So it is saying that there is a 12% chance that Nvidia's stock price drops down to the $120 strike price by this date. So for me, I like to be within a delta of 0.20 or lower. Now that's a bit conservative, but that's how I like it. Now that I have a much larger account, I'd prefer not to take on any unneeded risk. So if we come over to the delta column again, we can see right here at this $126 strike, it is a delta of 0.20. So I automatically know I do not want to go any closer to the money than $126. Now, there are some traders that like to do a delta of 0.30. So you could see, you could come over here. So you would select either the $131 or $132 strike. And for doing so, you would receive more money. However, I like to be more conservative. So if we go back up to the delta of 0.20, we could see at the mid price, if I were to sell a put on this right here, right now, I would get paid about $218. Okay, so you can see it shows $2.18, but that is the per share price. So every contract is worth 100 shares. So if you take $2.18 and times it by 100, you'll get $218. So that is the money that we would receive for selling that put immediately upon opening the trade. All right, so perfect. That's the first thing, is to look at delta, and we want a delta within 0.20. And then the second thing that I look at is the expected move. So here now I'm at the expected move page, and I'm currently using Bar Chart, which is a paid membership. However, you can find this information for free on Google. Just type in expected move for whatever stock you're looking for by whatever date, and you'll typically find it pretty fast. But the expected move is just the largest move that the options market is pricing in for that specific date. So if we scroll down, now if you recall, we selected the date of January 10th of 2025. So that is this date here. Now we can see that the expected move is 8.93%. And that puts us at an upper price of $150 and a lower price of $126.11. Now, how ironic that I already said that $126 was the highest that I would go, according to the delta. So that is perfect. That is the expected move. So like I said, the expected move is just how much the options market is predicting that the stock price will move by that date. All right, so $126 for this. Now, the third and last thing that I look at, and the only technical indicator that I use for this strategy, but wait. What if you can make money while on vacation, while spending time with your family without constantly worrying about bills? What if you can make the money for your entire vacation while on vacation? I personally trade options full time and generate multiple six figures per year, enough to comfortably provide for my wife and 6 kids, and our multiple vacations per year. In Trade to Freedom, I'll show you how to create passive income streams that keep paying even when you're not working. You'll get my exact trades as soon as I answer them. Imagine being able to take that trip you've always been dreaming of, knowing that your money is still working for you. The link is in the description below. I'll see you in the community. Are the Bollinger Bands. Now, Bollinger Bands are just a technical analysis tool that was created by a guy named John Bollinger in the 1980s. However, but it just consists of 3 lines essentially. Now, the middle line is your 20-day moving average. Now, you can set it to different time frames. However, it typically defaults to the 20-day moving average. And then the upper line or upper band is the moving average plus 2 standard deviations. And the bottom one is the moving average minus 2 standard deviations. All right, so let's take a look at a real Bollinger Band example. So here we have a screenshot of Apple's chart. Now you can see that majority of the time the stock price stays within the Bollinger Bands. And research has shown that 95% of the time that is accurate, that the stock price stays within the Bollinger Bands. And you can see that the very few times where it pops out of the Bollinger Band, it typically reverts back into it in a very short period of time. Okay, so came up here, tested the Bollinger Band again, came back down, came down on this day, and then quickly came back in. So that is the Bollinger Band there. Let's check out Nvidia. So this is a live view of Nvidia right now, and we can see that the stock price is within the Bollinger Band. It's pretty low to the bottom of it. But essentially what I do is I use the lines as signs of support. Since this bottom line here is the closest band to Nvidia's current stock price, I would use that price as support. Now, currently that band is at $135.72, as we can see there. And so what I do is I'll take the price of the band and then I'll take the price of the expected move. And whichever one is lower is the price that I will use. Okay, so we can see here the band is at $135.72, and we saw that the expected move was at $126.11. So since the expected move is lower, that is the price that I prefer to use. And so now that I have that information, we can go ahead and open up a trade. So here I am in Thinkorswim. That is a platform that I use to trade. I've already put Nvidia's ticker symbol, NVDA, into the options chain. And now we need to select our date. And we said that we would go with January 10th. So I will open that up. And we said the highest that we will go is the $126 strike. Now, Nvidia's stock price has gone down a little bit since I first started this video. So now the delta is 0.21 at the $126 strike. Now remember, I said I want to stay below a delta of 0.20. So now I'm going to go up to $125. So I will go ahead and right click and hit sell and then single. And now I need to select how many options contracts that I would like to open up. Now remember, when you're selling a put, you are agreeing to buy 100 shares of the company per contract. So you need to keep that in mind when you're opening up the trade, because the stock price could very well drop below your strike price by the expiration date, which will force you to either 1, buy the shares, or 2, close the trade at a loss. So the best way to do it is to sell puts on a company that you would actually like to own at a price that you would like to own it at. All right, so I am comfortable buying the shares at $125. Now at 100 shares, that would be $12,500 per contract that I would need to have readily available if I need to purchase the shares. But make sure you stay to the end, because if you do have a smaller account, I will show you how you can do this very similar trade with a much smaller account. Now I would like to do about 5 contracts. So I will select 5 contracts here. And then I am fine collecting $208 per contract. So I'll hit confirm and send. And you can see here that I will get $1,038.16 immediately for opening this trade right here, right now. Now you may see this max loss. It shows a max loss of $61,460. But that would typically never happen. That is showing a max loss if Nvidia were to go to $0 during this trade. And if Nvidia goes to $0, then we probably have much bigger issues in the world, and your money is probably not what you need to be concerned about. Okay, but that is why you do it on a very high quality company that you would like to own. Okay, so I'll get paid $1,038.16 immediately for opening up this trade. Now, if you have a smaller account, you can do a similar trade on a leveraged ETF that follows Nvidia. Now, if you're not familiar with leveraged ETFs, they simply look to move 2 or 3 times more than whatever stock or sector that is following. So if a leveraged ETF is following Nvidia, if Nvidia was up 1% for the day, then the leveraged ETF would look to be up 2 or 3% for the day. And the reverse is true as well. If Nvidia was down 1% for the day, then the leveraged ETF will look to be down 2 or 3% for the day. But a great leveraged ETF that follows Nvidia is ticker symbol NVDX. So let me pull up NVDX. Okay, and you can see it is a 2x leveraged ETF to Nvidia, so it looks to move 2 times more than Nvidia moves. And it is currently at $17.36. But we can come down to the options chain, you can select the exact same expiration, and you come over here and sell puts at these much lower prices than what Nvidia is currently trading at. And so, for example, if you were to sell a put at $15, you would only need $1,500 available in order to open up that trade. And we can see that the last contract that went through for this strike was $1.30, which means you would be paid $130 for opening that trade. So those are the 3 data points that I look at before entering into any trade: the delta, the expected move, and Bollinger Bands. But if you like this video, make sure to hit the like and subscribe button. If you would like to learn more from me, come and join the Trade to Freedom community. Not only will you get my real trades in real time, but you'll get my entire framework that includes my 5 different income strategies. But that's it for this video, folks. I'll see you at the next one. Peace.